Hello there. This video is the second and final part of the financial accounting template series. In the first part, we saw how to create the template, okay, in case you want to create it yourself and use that for your exam, okay. I showed you the various steps that go into creating the template and things you need to take care of so that you don't make any mistakes, okay. In this video, we're going to test this template using different exercises. So when I use numerical exercises, you can visually see how the template functions. And this might inform you more about how useful this template is for you and if you would like to purchase it. So without wasting any further time, we'll get started. In a different file, I have a few exercises here, which I'm going to use the template to solve them. Let's get started with the first exercise, okay? So the balance sheet of a particular company is given as of the end of October, okay? And you have a summary of transactions through November, okay? And you're expected to prepare journal entries for these transactions and also prepare a full set of financial statements as of the end of November, okay? So at the beginning of the period, you have a balance sheet, okay, and then you have a set of journal entries, and then you'll have to create the financial statements at the end of the time period, which is end of November, okay. So for that, I'm going to first copy the balance sheet information into my before sheet, okay. Remember, this is the sheet which I told you, where you can input the data at the beginning of the time period. Okay, so let's get started. So that's cash of 92,000, accounts receivable of 67,000. There's no allowance for doubtful accounts. Inventory of 140,000. Prepaid insurance of 8,000. Okay, you can either use the prepaid expenses section here, or you can use the other current assets and you can rename them if you want. Okay, this 8,000 prepaid expenses, I'm going to rename this as prepaid insurance. Okay, so in all the sheets it appears as prepaid insurance. Okay, so the changes in the name of the account, you need to do it in the journal entries sheet. You can see that it's reflected here. Okay, and then you have equipment of 360,000, equipment of 360,000, accumulated depreciation of 108,000. Okay, so our formula automatically deducts that from the equipment value, so you don't have to reprogram that. Okay, total assets is 559,000. Okay, it matches. And on the other side, accounts payable of 68,000. Note payable of 20,000. Okay, so the firm has a note payable of 20,000. Salaries payable of 6,000. Okay, so for that, I'm going to rename the other current liabilities account as salaries payable. Okay, so let me get there. Other current liabilities, I'm going to rename that as salaries payable. Okay, common stock of 400,000. Common stock of 400,000. Retained earnings of 65,000. Okay, you can see that I have noted down the entire balance sheet as of the end of October. Okay, assets and liabilities and stockholders equity, they match. Okay, now let's get started with the journal entries. So before we enter the journal entries, let's just have a quick look on what the after sheet looks like. Okay, the after sheet, as of now, we haven't done any journal entries, so the income statement is empty. But you can see that the final balance sheet, okay, is the same as the before balance sheet. Okay, it's the same because we haven't entered any journal entries yet. Okay, and there is no changes in the cash flow statement yet. Okay, so let's get started with the journal entries. A, the firm sold goods on account for a total selling price of 200,000. Okay, it's selling goods on account. Okay, so the revenue is 200,000, but cash hasn't been paid yet. Okay, so I'm gonna say revenue is a credit account. Okay, so in my first box, I'm going to credit 200,000 in the revenue section. Okay, you can see that my check doesn't balance yet because I haven't put in the debit account yet. Okay, so because it's sold on account, you still have an accounts receivable of 200,000. Okay, so accounts receivable is a debit account and I'm going to debit 200,000 then. Okay, you can see that now it's balanced. Okay, so that would be section A. I can call that A here. Okay, now to B, paid rent of 30,000 for the month of November. Okay, so they are actually paying cash. Okay, so cash is being credited 30,000. Why? Because cash is going down. Cash is leaving the firm. Okay, rent is an operating activity. So I'm going to select O here to reflect an operating activity. And it's a rent expense. Okay, by default, I don't have a section for rent. Okay, so I'm going to use other expenses. Okay, I'm going to debit 30,000 in my other expenses account. Okay, if we want, we can rename it to rent expenses if you would like. Okay, now journal entry C, paid salaries of 52,500 to employees during November. Okay, so salaries are being paid. So again, I'm going to credit 52,000. Was it 52,500? Sorry. So that's 52,500. I'm going to credit. Okay, and the cash again is an operating cash flow and it's a salary expense. So I'm going to debit salary expense 52,500. Okay, as you can already see that in order to use the template, you need to have some basic understanding of debit and credit, right? So an understanding of journal entries helps you do things faster, right? Having a template built. Okay. Part D, purchased inventory on account from a supplier for 87,000. Okay, so part D, purchased inventory on account for 87,000. So my inventory is going to be debited 87,000. Okay, because it's on account, I haven't paid the cash for it yet. Okay, so I'm going to have an accounts payable, which is a credit account of 87,000. Okay. Part E, collected accounts receivable of 123,000. Okay, part E, I'm collecting accounts receivable of 123,000. Okay, so my cash gets debited. Okay, because I'm collecting cash. Okay, my accounts receivable would be credited. Okay, again, my cash is an operational cash flow, so I put in O. Okay, if you want to see the numbers, you can widen the width of the columns. Okay, the next one, part F, paid accounts payable of 70,000. Okay, so from my accounts payable, I'm paying 70,000 of what I owe. Okay, so my cash is being credited 70,000. Okay, and again it will be an operating cash flow. And my accounts payable is going down by 70,000. So I will be debiting it by 70,000. Okay. Next, part G, paid utilities of $2,000. Okay, so part G, I will pay utilities of $2,000. So my cash goes down 2,000. Again, it's an operating cash flow. Okay, and utilities are other expenses, so you can use the other expenses account here. I'm going to debit the 2,000 using the other expenses account again. Okay, remember we've already used that to hold the rent expense in there. Okay, and we are also going to use that to hold the utilities expense there. Okay, next, required adjusting entries at the end of November. Okay, we need to make a few adjusting entries for the end of the month. Section H, ABC company paid the entire premium on a 1-year insurance policy on the 1st of July. This is the only active insurance policy as shown in the balance sheet as of October 31. Okay, so in the balance sheet you can see that there is prepaid insurance of $8,000. Okay, so that's as of the end of October. Okay, and the premium was paid on the 1st of July. So from July, August, September, October, 4 months have passed. Okay, and the insurance policy is still active for a further 8 months. Okay, so this 8,000 reflects the 8 months of prepaid insurance which still is active for the rest of the year and also for the next year. Okay, so if it's 8,000 for 8 months, we know that it costs about $1,000 every month. Okay, so now that November has passed by, okay, we are going to credit 1,000 from prepaid insurance. Okay, so let's get back up here. So that's section H. Okay, so from my prepaid insurance, I'm going to remove 1,000, or I'm going to credit 1,000. Okay, and it becomes an insurance expense. Okay, so again I'm going to use the other expenses section because I don't have a separate line. Okay, if you are creating your own template, you can, like, if you want to have more accounts here, more options for different accounts like insurance expense or rent expense, you can add them. Okay, and then moving on, section I, ABC company depreciates its equipment evenly over a 10-year lifespan. Estimated salvage value is negligible. Okay, so the equipment they have, they depreciate it over a 10-year lifespan. Okay, so you already have some accumulated depreciation. So how do you calculate the depreciation per year on a straight line? Okay, because they do it evenly. So 360,000 becomes 36,000 every year. Okay, and here we are looking at just November. Okay, if it's 36,000 every year, that amounts to a depreciation of 3,000 every month. Okay, let's get back here, section I, and I'm going to say I have a depreciation expense, okay, of $3,000. Okay, I have to debit that. Okay, and on the credit side, I'm going to add it to my accumulated depreciation of 3,000. Then part J, the note payable as seen in the balance sheet is a 1-year 6% note issued on October 1. The principal along with the interest will be paid at the due date. Okay, so if you see the note payable here of 20,000, it says that it's a 1-year note, okay, and it's a 6% note, and it was issued on the 1st of October. Okay, so let's calculate what's the interest that is owed every month, okay, even though it will be paid only on the due date. So 6% of 20,000 is 1,200. Okay, so that's the interest owed for the whole year, but per month the interest owed is $100. So it's $1,200 divided by 12. Okay, so the interest owed has increased by $100 with every passing month. So there would be an interest expense, okay, of $100, but it hasn't been paid yet. Okay, so we're going to call it a payable. Okay, we've already used salaries payable. Okay. We've already used the extra provision we had for salaries. Okay, so for now we're going to use the same account for the $100 that has to be credited. Okay, and if you want, you can also call it, okay, plus the interest payable. Okay, Okay, ideally you would like to have separate accounts for them. Okay, you can manage them whichever way you want. If you want to create an extra row, you can do that too. Okay, the next one, part K, employees earned a bonus of $4,000 and this hasn't been paid yet as of the end of November. Okay, so there is a bonus of $4,000. Okay, so there's going to be a salary expense of $4,000. Okay, which I'm going to debit it here. Okay, but it hasn't been paid yet. We have a salaries payable here. Okay, you can put the $4,000 there. Okay, the last one, part L, inventory on hand as of November 30 was calculated to be 137,000. Okay, inventory at the beginning of the month was 140,000. Now we have 137,000. Let's check if we bought an inventory in between. Okay, we purchased inventory for 87,000. Okay, so from 140,000, if you purchased 87,000, okay, your inventory on hand is 227,000. Okay, out of which, okay, you've sold some inventory. You see, in part A, you've sold some goods. We don't know how much the inventory was worth. All we know that was the selling price total to 200,000. Okay, so from 227,000, if the inventory that is left is supposed to be 137,000, okay, we've sold inventory worth 90,000. Okay, so basically we would say 227,000, okay, minus 137,000. Okay, so we've sold inventory worth 90,000. Okay, so that has to be adjusted for here in section L. Okay, so the previous section was K. Okay, so in section L, I'm going to reduce my inventory or credit my inventory by 90,000. Okay, and that 90,000 becomes my cost of goods sold for the period. Okay, so I'm going to debit my cost of goods sold, which is an expense, by 90,000. Okay, now we've done all the journal entries. Okay, let's just go up there to check if we've provided for all the cash transactions. If we've picked the type, we're looking at rows 4 and 5 to see if all the cash transactions have a type assigned to them. Okay, so far they all seem to be operational cash flows. Okay, also you can look at the check to see if all the debits and credits have matched in your transactions. Okay, now comes the cool part, because we've built the final financial statements, okay, by linking the before and the journal entries sheet. Okay, if you go to the after sheet, you can see that everything is already done. Okay, the income statement is fully prepared. You have a net income of 17,400. The statement of retained earnings is also fully prepared. Okay, then you have a balance sheet, which again with the assets and liabilities is already matched. Okay, so this will be the final balance sheet at the end of November. Okay, and then you can see the cash flow statement. The first cash flow statement was done using the direct method. Okay, all the cash flows were operating cash flows. Okay, and the second cash flow statement was prepared using indirect method. Okay, you can see that the cash ending balance is the same as the cash in the balance sheet. Okay, we have all the financial statements ready by just filling in the journal entries and the before sheet. Okay, so that's the beauty of creating a template ahead of your exam, so which allows you to save a lot of time. We encountered some difficulties along the way, which is very practical that it can happen to you during an exam. Okay, sometimes the number of provisions you provide in your accounts, okay, may not be enough, right? You might need to have a separate line for salaries payable and interest payable. Okay, in that case, just create an extra line. Okay, or just keep the name as other current liabilities, and you could throw in everything else that doesn't fit in the standard accounts. Well, that's it. That's the first exercise. It didn't take that much time because we had a template which had been prepared ahead of time. Now let's look at the second exercise, okay, which involves depreciation, and let's see how we can use the depreciation template we already have. Okay, Nothing Company bought a machine for $145,000 cash. Okay, so we're going to use the depreciation template. The acquisition cost is $145,000. Okay, the estimated useful life is 5 years, and the residual or salvage value is $20,000. Okay, estimated useful life is 5 years. Okay, you can see that because of conditional formatting, 5 cells have been highlighted in blue just because the useful life is 5. So in the case of units of production method, okay, you can already see that you have to input 5 numbers here to denote the actual production. Okay, the salvage value estimated to be 20,000. Okay. Assume the estimated useful life in production units is 240,000. Okay, we also have the estimated useful life in production to be 240,000 units. Okay. Units actually produced were 45,000 for, okay, so we also have the actual production for each of the years. Okay, so I'm going to fill that in here. 45,000, 42,000, 56,000, 26,000, and 35,000. Okay, part A, calculate the annual depreciation expense and net book value at the end of each year using the following 4 methods: straight line method, units of production method, double declining balance, and sum of years digits. Okay, we already have that because in our template we prepared it in such a way. Okay, so you can see that the straight line depreciation is 25K every year, and accumulated depreciation basically adds up each of these depreciation values. Okay, and the net book value goes down by 25K every year. Okay, so that's straight line depreciation. In the units of production method, okay, you can see that based on how much was actually produced, okay, your depreciation has been calculated. Okay, for example, year 3 has the highest actual production, and hence the depreciation expense is the highest for that particular year. Okay, in the double declining balance method, you can see that there is an accelerated depreciation, and with time it goes down. Okay, the last year has no depreciation because we've already depreciated the whole amount in 4 years. Okay, then the sum of years digits again is accelerated depreciation. You can see that depreciation goes down with time. Okay, and in both these accelerated methods we finish with the book value of 20,000 at the end of 5 years. Okay, so this is the depreciation schedule for the 4 methods. Part B, if the machine was sold at the end of year 3 for 60,000, calculate the gain or loss on the sale of the machine using the 4 methods. Okay, end of year 3, you're selling the machine for 60,000. Okay, when at the end of year 3. We've already performed these calculations in our template to provide you the solution automatically. So in each of these methods, you can see how much is the loss or gain when this asset is being sold at the end of year 3. You can see that how this can save you a bunch of time when you have to solve an exercise involving depreciation. The final exercise is on inventory management. Okay, let's try to see how we can use the template on inventory. Okay, Nothing Company uses a periodic inventory system. So a periodic inventory system, okay, is where the inventory management is done at the end of the period. Okay, whether it's FIFO or LIFO or weighted average, the calculations are done at the end of the period and adjustments are made. It reports the following purchase information for product X at the end of the annual accounting period. Okay, if 15,000 units were sold during the year, compute the ending inventory and COGS using the FIFO, LIFO, and weighted average costing methods. Okay, so they've provided you the purchase information. You also have the beginning inventory information here. So let's try to feed that in our template. Okay, so the beginning inventory is 2,000 units at, so the beginning inventory is 2,000 units at the cost of 5 per unit. The first purchase was on March 12, was for 5,000 units at a cost of 5.5. The next purchase was 3,500 units at a cost of $6 per unit. See, entering the dates here is completely optional as long as you use a chronological order. Okay. So the next is 8,000 units at 6.25. So 8,000 units at 6.25. The next purchase is 1,000 units at 5.75. The last one is 1,500 units at 6. Okay, let's just verify that information. Okay. And we also have additional information on how many units were sold. That's 15,000 units. Okay. So I'm going to say 15,000 units were sold. Okay. Now you can see that FIFO and LIFO were automatically calculated as to how many units from which batch were sold. Okay. And we can see that the cost of goods sold in each of these methods and the ending inventory have all been calculated automatically using the template. And if you'd like to reuse this template for further exercises, all you have to do is go to the reset sheet and click on wipe clean. Okay. And you can see that it automatically clears all the sheets with the information. Okay. So we can reuse them. So now using these numerical examples, you can see visually how the template functions. So if you'd like to create this template yourself, you can use the previous video where I give you step-by-step instructions on how to build this template. Or if you'd like to purchase this template, you can do so by visiting my website. I will provide the link in the description below. If you have any questions or if you face any issues with the template, feel free to write to me in the comments and I will try to get back to you as soon as I can. Thank you for watching. Cheers.